Welcome to InvestorWeb, your trusted guide through the complex world of finance and investment. Here at InvestorWeb, we pride ourselves on providing clear, reliable insights into the ever-evolving financial landscape. Today, we're focusing on a topic that touches many, the essentials of securing a loan. Whether you're contemplating a personal loan or gearing up for a major investment, understanding the prerequisites is crucial. Stay tuned as we delve into the 10 crucial checks you need to perform before signing off on any loan agreement. First things first, understand why you need the loan. It's crucial to have a crystal clear understanding of your reasons for seeking additional funds. Are you looking to expand your business, cover unexpected expenses, or perhaps fund an educational pursuit? Identifying the core reason will significantly influence the type of loan you should consider, the terms that suit your situation, and the amount you need to borrow. It's also essential to differentiate between a want and a necessity. Wants are often driven by desire, such as buying a luxury car or going on an extravagant holiday. Necessities, on the other hand, are obligations or essential needs like repairing your home's roof or covering medical bills. By distinguishing between the two, you can prioritize your financial commitments more effectively. Moreover, understanding the purpose of the loan helps in tailoring your borrowing to match your financial capacity and goals. A clear purpose will not only guide your choices but also safeguard you against unnecessary debt. Next, let's decode the interest rates. When venturing into the world of loans, two main types of interest rates come into play: fixed and variable. A fixed interest rate remains constant throughout the loan's duration, offering a sense of stability and predictability in your financial planning. On the other hand, a variable interest rate can fluctuate based on market conditions, which might lower your payments at times but also pose the risk of increasing them. Understanding how these rates affect the total repayment amount is crucial. For instance, a lower interest rate means less money paid over the life of the loan, making it an attractive option. However, it's not just about the rate itself. The fine print matters. When comparing rates between various lenders, look beyond the headline figures. Consider the APR, which includes any fees alongside the interest rate, giving you a fuller picture of the total cost. Remember, the lower the interest rate, the lower your total repayment will be. Now, scrutinize the terms and conditions. When venturing into the world of borrowing, understanding each clause of your loan agreement is not just beneficial, it's essential. The term of the loan dictates how long you'll be paying back the principal and interest. It could range from a few years to over a decade, significantly affecting your financial planning. Be particularly vigilant about penalties and fees. Late payment charges, prepayment penalties, and processing fees can seem minor at first glance, but can accumulate to substantial amounts. Hidden clauses are often buried deep within the legalese. These could include severe financial penalties for seemingly minor infractions or unexpected circumstances. Moreover, some terms may allow the lender to change interest rates or fees under certain conditions without extensive notice, impacting your repayment amount unexpectedly. This is why it's crucial not just to read, but to thoroughly understand every part of your loan agreement. Always read the fine print. It could save you a fortune in the long run. Who is giving you the money? Let's assess the lender. When considering a loan, the credibility of the lender should be at the forefront of your decision-making process. Banks, credit unions, and online lenders each bring their own advantages and potential pitfalls. Starting with banks, they are generally known for their reliability and comprehensive services. However, it's wise to check their customer service ratings and any recent news that might affect their stability. Credit unions often offer more favorable terms due to their not-for-profit status, which can lead to lower interest rates and fees, but ensure they are accessible and meet your specific needs. Online lenders might provide convenience and competitive rates, especially for those with less conventional financial backgrounds. Yet, due diligence is essential. Scrutinize customer reviews and verify their compliance with financial regulations to avoid scams or predatory practices. Choosing a reputable lender is as crucial as the loan itself. Make sure to research thoroughly and select one that aligns with your financial goals and values. Consider how the loan affects your credit score. A credit score is essentially a numerical expression that lenders use to evaluate your creditworthiness. It's based on your credit history, including the amount of debt you have, your payment history, and your credit utilization ratio. When you apply for a loan, the lender will perform what's known as a hard inquiry on your credit report. This can temporarily lower your credit score by a few points. However, the impact is often minor unless you're applying for multiple loans within a short period. Managing your loan effectively can actually improve your credit score over time. Consistent on-time payments demonstrate to lenders that you are a reliable borrower, which can enhance your creditworthiness. On the flip side, missing payments or defaulting on the loan can harm your score significantly. Before applying for a loan, it's wise to check your credit score. This can be done through various online platforms that offer free credit reports. If your score is lower than expected, take steps to improve it by paying down existing debts and ensuring your bills are paid on time. A healthy credit score opens doors to better financial opportunities. Let's talk about repayment flexibility. When considering a loan, understanding the repayment schedule is crucial. It's not just about when the payments are due, but how they can be managed to fit your financial landscape. Repayment flexibility can significantly influence your decision on whether or not to take a loan. Firstly, let's explore balloon payments. This option allows you to pay smaller amounts in the initial stages, with a large payment due at the end of the loan period. It's particularly useful if you anticipate a rise in income or expect a large sum of money later. On the other hand, prepayment privileges are a boon for those who might come into extra cash and wish to settle their debts sooner. By paying off your loan early, you can save on interest. However, it's essential to check if there are any penalties for early repayment, as these can diminish the benefits. Flexibility in repayment can be a lifesaver during financial crunches. Beware of fees and penalties. When diving into the fine print of your loan agreement, it can sometimes feel like navigating through a maze. Among the various twists and turns, fees and penalties stand out as crucial factors that can have a significant impact on the total cost of your loan. Let's unpack some of the common charges you might encounter. First, origination fees. These are charged by lenders to cover the costs of processing your loan application. They can vary widely, so it's wise to compare these fees across different lenders. Next, late payment penalties. Missing a payment deadline can not only hurt your credit score but also lead to hefty penalties. Understanding the grace period and the penalty amount is essential to manage your finances effectively. Lastly, prepayment penalties. If you decide to pay off your loan early, some lenders might charge a fee. Always ask if your loan agreement includes such penalties, as they can negate any savings you hope to gain from early repayment. Unexpected fees can significantly increase the cost of your loan. Should you consider loan insurance when you borrow, whether it's for a car, a home, or for personal reasons, you may be offered loan insurance. This type of insurance is designed to cover your repayments in case you're unable to meet them due to illness, injury, or unemployment. Loan insurance sounds like a safety net, doesn't it? It ensures that during tough times, your financial commitments are managed without defaulting. This can protect your credit score from the negative impact of missed payments. However, it's crucial to understand exactly what is covered. Policies vary significantly, and not all circumstances may be covered. Now let's weigh the pros and cons. On the plus side, the peace of mind it offers can be invaluable. On the downside, the cost of premiums can add up over time, potentially making your loan more expensive in the long run. Moreover, it's essential to read the fine print. Some policies have strict eligibility requirements or do not cover certain types of unemployment or health issues. Loan insurance can be a double-edged sword. Choose wisely. Finally, always look for alternatives and comparisons. When venturing into the realm of loans, the savviest move you can make is to compare multiple offers. This isn't just about finding the lowest interest rate, it's about understanding which loan features align best with your financial strategy. Each lender presents a unique combination of terms, fees, and benefits, making comparison not just wise but essential. Think beyond traditional bank loans. In today's diverse financial landscape, alternative financing options abound. Peer-to-peer lending platforms, credit unions, and even crowdfunding could provide more suitable, flexible, or economical solutions depending on your specific needs. Remember, the more you explore, the better your understanding of what's available. This not only enhances your chances of securing a more favorable deal, but also arms you with knowledge that could negotiate better terms. So take your time, scrutinize the details, and weigh your options carefully. Comparing offers ensures you get the best deal available. Let's quickly recap the essential checks before you commit to a loan. First, thoroughly understand your financial needs and how they align with the loan's terms. Decipher the interest rates and know how they affect your total repayment. Scrutinize the terms and conditions, ensuring they match your capabilities. Evaluate the lender's credibility and the impact on your credit score. Consider the flexibility in repayments and be wary of hidden fees and penalties. Lastly, explore insurance options and compare alternatives. Thank you for watching Investor Web. Don't forget to subscribe for more insightful finance content. See you next time.